Today, in this particular video, let's try to understand why planning is very much required before investing. You are doing randomly investment. So, what is you may not see your entire investment going into which direction. So, when you see a maybe helicopter view of your overall life, that point of time you will have proper clarity and proper direction. You need to take your life into which direction. So when you have a clear goal, that point of time, your probability would be in higher side. You may achieve your goal, and or you may move into your proper direction. Number two, when you do not have proper plan in place, that point of time, concentration risk of your investment will increase. What does it mean? Say, for example, you may see कि one particular product is giving you highest return, or say for example, equity is giving you highest return. You may chase only that particular return and your more allocation into one asset class like equity. And when that opposite market cycle comes, and so you may invest into higher valuation when opposite market cycle comes. That point of time, you may occur losses. So that is why proper planning is required. Proper asset allocation is very much required. When you do this particular planning, that point of time, you will have proper asset allocation. You may have investment into equity, and in equity also different sectoral allocation. Then you may have asset class level allocation like gold, like debt, this kind of then real estate, this kind of overall asset class level allocation based on your cash flow, risk appetite, and other stuff. Then you may have emotional biasness. Emotional biasness is a very dangerous thing because say, emotional biasness, say for example, you may not control your greed and fear. Okay. Say for example, when you are getting more and more profit, you are investing into that particular thing. But market actually goes into different cycles. Okay. So that point of time, your emotional biasness may actually stop you to do the right to go invest into right product or go into right direction. Say say for example, when market is down, that point of time we all know ki you may do SIP, more SIP, so that rupee cost averaging will happen. Okay, so when that opposite cycle comes, that point of time it will make you may earn good amount of money. Okay, but emotional biasness stop you to do this particular thing. When you do not have proper planning, that point of time you may lack planning. So your tax planning may be poorer. For this particular product, you just invest into that. The amount come for this particular product, you just invest into that. You don't have proper planning. Ki, this is your life goal. This is your cash flow. So you should do your cash flow analysis. How your cash flow is coming out of that. How much should be there in your emergency fund, then how much you should do for your midterm goals, how to invest into this particular midterm goals, then how to invest into your long term goals. So this proper planning along with basis, whenever it is required, proper review is very much required. Okay, so without review you may not understand key it is going into which direction. Two scenarios, someone is doing planned investment, someone is doing the random investment. Planned investment is more systematic, it is more disciplined, it is more research oriented. Research, I'm talking about random investment. So it is more impulsive. Someone is showing ki this particular product has delivered that much of return. By seeing return without understanding its risks involved into this, and your cash flow, your risk appetite, you are just investing into that particular product. And also market cycle, also timing is very much required. It maybe go into very much unstructured way. It is not based on your risk appetite. Asset allocation may not be proper. So it is like more into emotional biasness may come. Okay, now make what may happen risk management process when someone is doing more planned kind of approach management. So he may manage their risks more by doing proper diversity. And when you are going with without planning, because of without planning, your risk may be higher in random investment. So what someone should do? So first thing first, define clear financial goal before investing. This is the first thing. This is the base of any investment. Educate yourself about the different financial product and what is risk involved into that. Diversify your portfolio across different asset classes. Review and rebalance your portfolio whenever it is required. Take professional professionals guidance. Hope you understood uh, before any kind of investment why planning is very much required. Thank you.